Hey guys, my name's Charlie, and welcome to episode 3 of Investing One-on-One. Today we're going to be answering the question, what are the different types of equities? The first type of equity I'm going to talk about is called a stock. In my first video, we already talked about what a stock was, but to review, when you buy a stock, you buy a percentage ownership of that company, or you have stock in that company. When you buy a share of Apple, you become a partial owner of Apple, although you would own a very, very small percentage. You might be wondering, what is equity? Equity is simply ownership in a company. However, you can have that ownership in many different forms, and that's what we're going to talk about today. One important word to know for today's video is volatility. Volatility is simply how rapidly a given equity changes price. A highly volatile equity would have a greater opportunity for growth and a greater opportunity for loss. But a less volatile equity would have a lower opportunity for growth, but also less opportunity for loss, so it's more safe. Stocks are typically the most volatile type of equity. As they're only representative of one company, they can rapidly change price when the company releases information, there are government decisions made, or new news comes out related to them. The next equity type we're going to be talking about is called an ETF. An ETF is a grouping of stocks. An ETF experiences growth or loss based upon the stocks within the group. One type of ETF is called an index fund. The S&P 500 is one such index fund. The S&P 500 is simply comprised of the 500 companies with the largest market caps in the world. While higher value companies do have a greater effect on its performance, all 500 companies have an effect on the price changes that the S&P 500 experiences. Another type of equity is called a mutual fund. When you buy a mutual fund, you're essentially paying someone else to manage your money for you. Mutual funds typically charge higher fees than an ETF does. That's because of the higher level of attention that a mutual fund puts on your money. While an ETF remains relatively stable in terms of its holdings, a mutual fund can make trades every day. That level of focus and adjustability is what people are willing to pay the premium for. The reason why ETFs and mutual funds are less volatile than an average stock is because they're a grouping of stocks. The group spreads out the risk and makes the group of them as a whole less susceptible to changes in price. I hope you enjoyed the video and it helped you to understand some of the different types of equities that are available. Make sure to watch out for my next video, how to deal with volatility or risk in the markets.